Okay, well, welcome to the Left Field Investors meeting for March. I'll introduce our guest in a moment, but I just wanted to address a couple of things. One is the Passive Investing from Left Field podcast launched February 28th. We've got 4 episodes up. So please, it would really help if you can subscribe and give it a rating on iTunes or wherever you listen. That just helps us get the podcast to others. So if you haven't subscribed, please definitely do that. And if you like it, give it a 5-star rating. If you hate it, just don't rate it at all.
I was going to follow up on that. Yeah. Okay. Thank you for clarifying.
Yeah. Thanks, Mike. I appreciate it. And so a couple other things. One is, as you're talking to sponsors, please remember to mention our group. It really does have an effect. We're talking to several sponsors who are thinking about lowering their minimums if we can get enough of our group to invest. So it's important that you tell them where you're coming from, just so they realize that we're a large group and that we do invest. So please do that as well. Another thing on Facebook, we don't do much on Facebook other than post the podcast and post the blogs, but it is a way to generate some activity and get some more people to join. So if you haven't joined our Facebook group, please do that. You can just go to Facebook and search Left Field Investors and you'll find us, and go ahead and join. That'll help drive some people to our group. And also, if you know anybody who's interested, please, word of mouth is a good way to get our group going. We don't want to, just grow it for any reason. We'd like to get like-minded people, quality people who are interested, and we want to spread the word. So help us do that. Also, the infielders, just a reminder, we're about 45 members, so we're just about to 50. And after that, it's going to go up to $199. We have almost 500 posts on 60 different topics. So the forum is really getting going. There's some good stuff there. It'll keep improving the more that we all get on there and help each other by commenting. We did have a infielders meeting on March 15th, which was really, really good, I thought. And that's where we talked about different share classes, preferred equity, and how that affects your investment. And it was really surprising because I went in there thinking, anytime there's multiple share classes, you don't want any part of it. But I came out thinking, that's probably not accurate. You can find a way to still invest, and it makes sense. So that's the infielders. If you have any questions about any of that, let me know. Finally, Kenny Wolf, for those of you that are local in Columbus and don't mind going to restaurants, Kenny Wolf's coming, I think that's tomorrow night.
Tomorrow night, yep. Okay,
if you want to join, please contact Chad, or if you don't know Chad's information, you can contact me and I'll forward that to him. We'd love to see Kenny. I understand some people are more comfortable in restaurants than others right now. I won't be there, but I know Chad will. So if you're comfortable, please go. Kenny's a great guy and he's a big supporter of ours. So if you're comfortable going, please do. And with that is all of the stuff I need to cover. I do want to introduce Chris here from Harvest Returns. And I usually don't read the bio, but he has a very interesting bio. So I am going to read it. So please bear with me. Harvest Returns, what they do is they're passive investment opportunities in farming and agribusiness. They have 2 deals open right now that I saw because I'm on their email list. One is a vertical farm in Las Vegas, which sounds really interesting. Another is an indoor salmon farm in New York, which is also pretty interesting. I'm only in a couple of agricultural investments. One is a soybean farm, and another one I just got into with Pharmafield, which is I bought a cow. So that's pretty interesting. But I'm super excited to hear what Harvest Returns has to offer and learn a little bit more about it. And we're lucky, as I said, to have the CEO of Harvest Returns, Chris Rawley. So while serving as a career naval officer, Chris visited dozens of war-torn and poverty-stricken countries and began to appreciate the importance of agriculture to every single person on earth. As a professional investor with his newfound appreciation, he decided to invest in a farm, but quickly discovered that these types of assets were inaccessible to the average person. And that drove him to create Harvest Returns in 2016. He's invested in real estate and income-producing agriculture for nearly 2 decades. He's an angel investor in early-stage agriculture and food companies, including the Indian agriculture fintech company. I'm going to mispronounce this, Jai Kassan. He serves on the advisory board of AgTech startup Agrofides, maybe. Chris is a captain in the Navy Reserve, serving as the Reserve Chief of Staff for the United States 6th Fleet and helping to manage hundreds of sailors operating across Europe and Africa. During his 28-year military career, he has filled a variety of leadership positions in naval, expeditionary, and a joint special operations unit afloat and ashore. He is deployed to Afghanistan, Iraq, throughout Africa, the Middle East, and Western Pacific. Chris has a degree from Texas A&M University, earned an MBA at George Washington University, and is a graduate of the U.S. Navy War College. So Chris, welcome, and clearly thank you for your service, and thank you very much for being here. And with that, I will turn it over to you.
Hey, thanks a lot, Jim. Great to be here. I got to start out with a quick dad joke that's better than Chad's. So a three-legged dog walks into a bar and he says, "I'm looking for the man who shot my paw."
Nice.
So, yeah, I'm glad to be here. You know, I would probably consider myself an unofficial left field investor because this is the type of stuff I've been investing in for most of my career. Yeah, I've started out kind of playing in the stock market during the .com bubble era and learned some hard lessons that way, that it's better to invest in tangible real assets. So I started investing, did the single family route, did some fix and flips, you name it. In real estate, I've kind of played in that realm. Also, more recently, enjoyed passive investments, both with syndicators and via real estate crowdfunding platforms. And it was that kind of latter experience back in 2015, 2016 that got me interested in making agriculture in particular more accessible to more individual investors. And so got together with fellow Aggie and veteran Austin Manis, and we launched this company in 2016. So I want to go ahead and share my screen. That's okay. I think it's, can everybody? Okay. Does everybody see it? Can somebody? Okay, great. So yeah, it was you know, Jim read my bio. You can see I've been to a lot of places and done a lot of things in the military, and as part of those travels, saw a lot of people who were much more dependent on agriculture and much more in touch with agriculture than we are. Who, you know, we go to a grocery store, Whole Foods, whatever, and expect to see a variety of fruits and vegetables available 24/7, 365. Don't really care where it comes from. Most of that produce, by the way, is imported. So, you know, we're very passionate about helping farmers, and we're also passionate about helping investors. And what I want to talk about is how consumers, what kind of drives our thesis in agriculture is that consumer preferences are changing. And you can see the little word cloud. You know, when I grew up, I ate whatever my mom put in front of me, which was usually like Hungry Man TV dinners or a can of soup or whatever that came off the grocery store. I think a lot of folks probably my age grew up that way. Well, now, you know, kids are going to school with organic, free range, bento box, whatever that their moms are putting together, you know, spending a lot of money, consumer free discretionary income, and they're demanding very special kinds of diets and produce. And one of those themes in particular is local growing, and I'll talk more about that, why we like that particular class of investment or asset class. So at the same time, agriculture production is changing. It's evolving very rapidly here in the U.S. Europe and in the Middle East, in particular Israel, have been doing indoor farming for quite a while now. For us, this is a new thing. And when I talk about controlled environment agriculture, it's basically talking about indoor agriculture production. And that ranges everything from a small urban vertical farm doing hydroponics to multi-acre, large-scale greenhouses in rural areas that are producing on a regional level. And at the same time, people are starting to get more in touch with their food supply chains because they have to. Last year, we saw that picture on the right. Many of us, a lot of empty produce sections and meat sections when the pandemic started, and that was because there were shipping disruptions. There were also labor disruptions caused by pandemic. Something like 80% of the fruits and vegetables we eat in the United States are produced in California, in places like Salinas Valley. So you can think about that this is a much more brittle supply chain than a lot of people would like to admit. And because of this, people are looking for different ways to produce food in different places than it's been traditionally produced. And, at the same time for us, we see farmers who are doing these sorts of specialty types of production. And one of the questions we often get from investors and some other farmers is, why should I come to you guys when there's such a, USDA has guaranteed loans. We hear so much about government subsidies, billions and billions of dollars now with all the stimulus that and last year with the tariffs that Uncle Sam is pouring into farms. And that is all very true. But the vast majority of those funds in that financial system is geared towards row crops. So you drive through Nebraska, and if you're a fourth generation farmer of corn or whatever, it's pretty easy to get a USDA subsidized or a guaranteed loan. If you're trying to start a vertical farm in Birmingham, Alabama, it's damn near impossible because the banks don't understand it. The local ag credit unions don't understand it. Nobody really understands it. So, but it produces an interesting investment opportunity for those that have a little bit of risk tolerance and are willing to educate themselves on why agriculture is an interesting asset class. So for us, we like some of the reasons we're bullish on this asset class is the demographics. Obviously, the world population continues to increase. Supposedly, there's going to be 9 to 10 billion mouths to feed by 2050, and as those mouths get more wealthy and the world as a whole is getting more wealthy, more people are coming out of poverty to eat more protein. So that protein's got to be produced somewhere. From a return standpoint, farmland, and this is just one little specific niche, American farmland has actually outperformed other investment classes. Some of you probably saw that Bill Gates is now the largest private owner of farmland in the United States. Warren Buffett's a big owner. Obviously, Ted Turner's got his hundreds of thousands of acres of land where he raises bison and other things. So the high net worth people have realized this. Institutions have realized this for some time now. Back in the 80s, institutional investors like pension funds, university endowments started diversifying into farming and timber as part of their portfolio allocation. And now, up until very recently, it's been pretty challenging for individual retail investors to get into the asset class. Yeah, you can go on and there's some things like farmland partners. There's some publicly traded REITs, which are not bad. I will say that they are part of the stock market. So farmland partners in particular, I've met their CEO, I've talked to them. They took a big hit a couple of years ago when some blogger wrote a negative thing about their company. Whether it was true or not, it doesn't matter. They are not necessarily uncorrelated with the stock market. And so that leads us to the next one, that diversification standpoint. Agriculture, for the most part, is not non-correlated to the stock and the bond markets. You've got people who are able to diversify without worrying about corrections in the market or corrections in other asset classes. And these, like many of the real estate deals you guys are familiar with, are illiquid for the most part of investments. So there's another sort of safety factor when there's wild market swings. And then the other part is improve the food system. So there's some environmental reasons to invest in some of the products that we put together because they use less water, less herbicide, less fertilizer, those sorts of things. There's not the runoff. And in the case of cattle, I'll talk a little bit about that. There's the regenerative agriculture aspect, but there's also, keep farmers farming. Farming is increasingly, the average age of the farmer in the US is 58 years old. The vast majority of family farms are still or the vast majority of farms in the US are still family owned. However, you've got a lot of absentee landlords, farm landlords. So you have investors coming in. So one of the things we like to do is help get new people into farming or keep multi-generational farming, even though it might be in a different way. One of the vertical farms we've done was like a 4th generation sort of row crop farmer, but he decided to build his own urban farm and sort of diversify. So we like that improving the resiliency of the food system and also diversifying into locally grown foods. So there's a few different verticals if you go on our platform that we like to talk. We probably get maybe a dozen or so farmers every week that come to us with their deals, and of that we neck that down to less than 3% of the people actually get on the platform, or 3% of the businesses that come to us actually get on the platform. So the one, as I mentioned, is controlled environment agriculture. We're seeing more and more investment, and when I say investment, institutional investment coming into large deals. There's a company called AppHarvest, which did a very large vertical farm or greenhouse farm in Kentucky. It got acquired about 2 weeks ago by a SPAC, so that special purpose acquisition company. So there's a lot of movement. You're starting to see some agriculture unicorns out there, and controlled environment agriculture is a way to produce food closer to where it's consumed, which is better for the environment and better for a lot of reasons. There's also multiple growing cycles. You can grow food where it wasn't meant to be grown. We're displacing a lot of the imported vegetables that are coming in year round from other parts of the world, and now growing them locally in greenhouses or hydroponic farms. Same thing with permanent crops. Those are, there's a picture of an apple orchard there, but it includes things like tree nuts, hazelnuts, pecans, things like that. Avocados. There's some investment opportunities out there for retail investors in that, and this is a thing we like. It takes a while. You're dealing with biology, so unlike when you go out and buy an apartment building, you're getting cash flow from the get-go. You're having to wait for cash flow. So we try to structure deals creatively that produces some cash flow up front. The other thing about these sort of tree crops is they tend to be long-term sorts of endeavors. So, there's opportunities to go and buy timber and things like that you're going to want to hold for 20 years. We work to because my investment background is a lot of real estate. We work to structure some of our deals like commercial real estate, where there's a predetermined exit with a couple of multiple pathways. And then the next sort of deal we've got into is AgTech. And this is companies that are coming to us because they see that we have self-selected agriculture investors that are doing innovative things. We raised about $600,000 a couple of weeks ago in about 48 hours for a company that's doing precision livestock technology, which enables like computer, I don't even really quite understand it, but it's like machine learning, vision sensor technology that enables livestock operators to monitor their cows basically with a lot less manpower. But you're using kind of the rancher's eye. It's all baked into the AI. So these are kind of your more speculative deals, but they're also potential for higher returns. So that's kind of more of an angel type of investment. And then, just a little bit about the company. As Jim mentioned, we're both veterans. We've got veterans on our advisory board. We've got a pretty great team, I think. Involves people that have an ag background, a finance background, investing, accounting. Got a great accountant, and then we have an advisory board who is tremendously experienced, that brings their breadth and depth of knowledge to help us. We're a privately owned company. I don't have any big outside investors, VCs, or anything like that. When you're investing in this company, you're primarily dealing with me or my co-founder, Austin. We got a big deal pipeline. As I say, we get about a dozen deals a week, and most of them we throw away. But some of them we're looking for those nuggets that we think are going to produce a team that can execute what they say they can execute. We closed 22 deals for the most part, with the exception of 2 deals that were based on hemp, and I will likely never touch that product again. They've all gone well. We've had a couple of exits already. We do debt and equity. And then, for those of you that have capital gains, we do have an opportunity zone fund that we've deployed some capital into. So I'll leave it at that. Happy to answer your questions about agriculture, our company, whatever.
Great, thank you. Can you stop the share so I can, it's easier to get the questions that way. So if you have a question, you can either just unmute and I will call on you. I think that's the easiest way, or you can just send a message. Since I'm talking, I always like to ask the first question. That's the benefit, I guess, of being the host. Chris, can you talk a little bit about how do we analyze these deals? I mean, we have a deal analyzer for multifamily and we're working on that for some other assets. But I look at, the two deals you have now that I've seen, and usually we don't have people talk about specific deals, but this is so different for most of us and interesting, like a salmon farm. I have no idea. How am I going to figure out if that's a good deal or not?
Yeah. So what I like to tell people is if you've seen one sort of multifamily deal, you've more or less seen them all. If you've seen one farm deal, you've seen one farm deal. Now that's take that with a grain of salt, because there are, if you're going out and buying row crop acreage in the Midwest, it's pretty easy to look at, and there's some software and some websites that will help you look at like soil fertility. You can look at, crop, you can look at the annual crop rents and what that has done, trending, the commodity prices, things like that. There's commodity hedging. It is complicated and different necessarily from real estate, but the basics are the same. You've got revenue, and in our case, that revenue is produced instead of by tenants, by biological processes, whether that is salmon being raised in a tank inside and being, sold at whatever the going price is for that type of product, or trees growing. And again, that one, they take a while. So you plant a tree and it might take 3 to 5 years, depending on the type of tree, to start producing. And it's going to have a curve where it produces more and more and more. And then at some point, it's going to have a lifespan of production, and there's depreciation involved with those types of things. So what we look at in our due diligence process is we're going to dig through their financials. We're going to look at cash flow. Cash flow is king. We're going to look at, are their estimates fairly conservative as far as what they think their production can take. We're doing a lot of the projects we do are like development. So they're like, in real estate terms, kind of like brownfield projects, where you're taking a piece of dirt and you're putting up a vertical farm, or in some of our cases, you're taking a vacant building and putting a vertical farm in it, and the farmer's leasing it from the landlord, or sometimes they're putting up a purpose-made building or purpose-made greenhouse. So the deals vary. There's a lot of educational material. We've got blogs and podcasts and things like that where we talk about some of these different types of production. But it comes down to, like any other investment, doing your due diligence, digging through the PPM, digging through the sponsors' materials that they put forth. And we do, when we syndicate a deal, we are sometimes we'll invest ourselves, sometimes I'll invest personally. Usually we'll take a carried interest that kind of aligns our interest with the interest of those investors. We come in as a Delaware Series LLC, so we pool investors. And maybe I'm answering other people's questions, or maybe I'm jumping ahead, but we pool investors together, and then we invest as a single person, a single entity on a cap table, or we loan that producer money. We've done cattle notes, grass-fed cattle notes that have been very successful for the investors that are looking for cash flow and yield that yield anywhere between 7 and 14%. And we've had a couple of exits with those. We'll have another exit here in a few months.
Okay. Mike, did you have a question?
Yeah. So it looks like you're primarily headquartered out of Texas, but I'm assuming you're national. Is that correct? Okay. Just a little about my background. I grew up on a 250-acre farm with 100 head of beef cattle in Northwest Ohio. My father was a part of the Ohio Agricultural Research Development Center, which is a subsidiary of Ohio State University. This kind of touches on me a lot, being really the product of 3 generations of farmers, and watching, and witnessing the difficulties and the challenge about agriculture and the transitions that we've gone through. I think I've sold myself on my generational obligation here. I would just love to know more about numbers and opportunities and how better to get those from you.
Yeah, so Mike, we talk to a lot of guys like you or your kids, if you have kids, you know, that have that background in farming and that want to somehow support it or
already written off the kids. So anyway,
yeah, okay, but we you know, we talk to a lot of people that they're in touch with farming because they grew up in it or whatever. Yeah. And, you know, I saw something at a conference a year or two ago that the average net worth of the American farmer is, or the average annual income of the American farm may not be the farmer, but the farm is minus $1,500. And, you know, people that have been in row crop farming, they totally, you know, give me the head nods that that's correct, because you're so much at the mercy of the elements. You're so much at the mercy of commodity prices. And that's part of the reason that we sort of avoid those types of products. Now, there are some of our competitors out there that you can invest in that. And at St. Jim, it sounds like you're invested in a farm. And that's not to say that that's not great. I mean, Bill Gates would not have bought, I don't know, however many billions of dollars worth of farmland if row crop farmland was not a good investment. That's just not what we do. As far as our numbers go, you know, we've got debt deals that range from an internal rate of return, basically 8% to, like I said, 14%. Some of the equity deals, we generally, when we talk to our equity guys, we want north of 10%. So 10 to 20%. Some of the more speculative deals, you'll see higher multiples, like the AgTech deal. They're promising, I think it was like a over a 10x multiple, but that's typical sort of VC math. They've got a plan for subsequent funding rounds. So we try to be the one-stop shop for people that want to invest in agriculture. If you're pretty conservative and just looking for yield, that's one thing. If you're looking to be more of an angel investor, that's another. And we do both of those.
No, that's great. I mean, again, you mentioned Salinas Valley, and I drive through that routinely and see the truckloads of all the produce heading up and down I-5. This is interesting. It is something I think my father would be interested in too. So I might bring in, he's got a lot more connections to the ag industry than I do. So thank you, Chris. Thank you for speaking to us today.
Okay, Chad, you got a question?
Yeah, Chris, again, appreciate you being here tonight, and thank you for your service as well. I'm also a farm boy, and it hits near and dear to my heart too. I was wondering if you could speak more on the ag tech side. I find it really interesting watching people get excited about Tesla and self-driving cars, and I think of, we've had a combine that's driven itself in the field for years now because the tech was there before it made it to the road. That I find it interesting that the agriculture world could be ahead of some of the other private industries that are out there too. But could you maybe speak to that side of things? And I was going to piggyback on Mike's question. What are your hold times for a lot of these as well, to understand that side of things with the investments also?
Yeah, Mike. So, you know, you could break ag tech into a few different sectors. Certainly indoor agriculture is a piece of it. There's all what we call like the pick and shovel guys. You know, the guys that went for the gold rush weren't necessarily the guys that prospected gold. It was the guys that sold them the picks and shovels. They made all the money. So a lot of the early investments in indoor agriculture are the LED lighting, the growing systems, the algorithms, the software that mitigates that. And we've got relationships with some of those companies. The problem was that there's a lot of VC money that poured into a lot of those companies, which is great, but the farmer can't afford their technology. So that's kind of where we come in, is to help some of these farmers get their farms to be more high tech. Mike mentioned like you mentioned like auto steer tractors. Okay. Yeah, now we're starting to see robots. So take out the man from the auto steer tractor. I mean, he's there probably watching movies on his iPad anyway, right? So that's the next step. So we're seeing some robotics company. We had like 3 different robotics companies we had conversations with. The sustainable types of soil additives, we're seeing a lot of that right now. So this is products designed to produce sustainably produced crops. So it's either organic types of fertilizer inputs and things like that. And then you can get into even more exotic things like the, the CRISPR GMO technology. I'm just absolutely not an expert in that, especially, but it's out there. There's a lot of institutional money and research, primarily from the big ag companies, going into that.
What about hold times too?
Okay. So hold time. So we've done debt. Our debt right now, the shortest we have is a year. We've done debt as short as 6 months, but after we went back and forth with the farmer, we are dealing with the company. We are dealing with biological processes, and this was grass-fed cattle. They determined it was a little bit easier to do a year, so we've got notes that range from a year to 3 years, and again, those interest rates are 7 to 14-ish%. Some of them pay quarterly. The longer-term notes pay quarterly. The short term, the 1 years pay out at the principal and the interest at the end. It's kind of a balloon payment. The equity deals, anywhere between 2 to, let's say, 8 years for an exit. And when we work with our sponsors, we're looking for multiple paths to exit. So in the case of developing, say, an indoor farm where you're starting from scratch or starting with a shell building, it kind of works like a utility. Like there's a lot of upfront CapEx, and then you basically are spurting out money once you're up and growing produce and distributing. So you've got one of the extras we'll look at as a cash out refinance. So we'll put the risk, our investors will take the risk up front, and that'll come in as CapEx, and then they'll be able to conventionally refinance 3 to 5 years down the line when that thing's cash flow stable. There is some potential for mergers and acquisition. We've seen so many of these smaller mid-sized farms coming up. We do think there's going to be a lot of M&A in the next 3 to 5 years, as what happened with that AppHarvest getting acquired by a SPAC. And there's more ag specs on the way, and ag and food tech specs that we've seen popping up. Although, I mean, you guys that have heard of SPACs or looked into them, they're a great deal if you're the sponsor. They're not such a great deal if you're the investor. So I am personally staying away from those. And then there's, cash flow, basically cash flow out our investors at a target IRR. So we're always looking for multiple exits.
Thank you.
Okay, I see Sean was clapping, but we're only taking hands raised, so we're going to have Steve ask the next question. You can go after that, Sean.
Hi, Chris. I did not grow up on a farm, but my dad did grow up on an apple farm in South Korea, and my grandfather, who's almost 99 years old, has lived there all his life. So it's interesting to see all the developments around that farm in South Korea because of the population growth. But anyways, 2 questions. Number one, are there any tax advantages in any of the deals that you do in terms of depreciation? And then also, I am on your email list, and I didn't really get any feel for, have you had any exits on any of your deals? And by the way, I did invest in your AgTech deal a few weeks ago.
Yeah, Steve, that was a hot one. Thanks for your investment. We still have people, hey, can I invest in that one? No, you can't. We already closed that round, but we'd like to do more like that. So wait, tell me, I'm sorry, I got distracted with the questions.
The tax benefits.
Oh yeah.
And then the exits.
Tax and exits. Okay, so the second part first. Exits, we've had a couple of debt deals exit. We'll have more debt deals exits this year. We expect to see our first exits from our equity deals, first couple of equity deals. The average deal duration on our platform is only, I think, about 15 months at this point. So we really, we launched in 2016. That was a formative year, just kind of getting our stuff together, getting our technology together. Laying the foundation. And then 17, we did a pilot deal. And then 18, 19 is when the momentum really started to pick, in 20, where the momentum really started to pick up on the investment. So we expect some equity exits this year. And that'll be, I think, at the 3-year point for those first couple of years, or 2.5-year point. And then we've got more, kind of lined up. And if you want, Steve, since you're an investor, I can kind of share with you our overall deal performance. If you shoot me an email tomorrow, we'll get that for you. Then the tax on the equity deals, we'll see, if there's any kind of CapEx, you're going to get depreciation. So putting up a building, same as real estate, typical depreciation. As I said, trees depreciate. They're a depreciable asset. And a lot of these you're getting, because of various ag exemptions in various states, you're getting lower. You're not paying the property taxes like you would be on a, residential or commercial office structure. And then there's, you'll see phantom losses. Those are the good kind of losses sometimes on the first couple of years of the deal before it starts cash flowing. As all that, that negative income comes out, you'll get a K1 that'll show a loss if you have to offset some of your gains from your other stuff.
Okay, Sean, you have a question?
Yeah, Chris, just a quick question. Obviously with this kind of farming, you're less concerned about climate, the whims of climate change per se, but acts of God, I would guess, are still a concern for you, especially with the vertical buildings and the greenhouses and things like that. And where I'm going with this question is I'm part of a family partnership that owns 900 acres in Iowa. And a lot of what you just talked about is definitely a concern to us. But an act of God going through Iowa last year, the derecho that hit, was an absolute revenue killer. So, being based in Texas, I would guess hail belt, tornado belt is a lot of where your farms are. Have you been impacted by any acts of God from a revenue standpoint on your deals?
Yeah. So our deals, first of all, Sean, our deals are all over the country. I would say the primary act of God that we got hit with last year, as everybody else did in the economy, was COVID. Most of our sponsors, especially our grass-fed guys, it was a boom for them because they are generally smaller producers and they are not using the Tyson processing facilities. They're using smaller regional processing facilities. So, when those Tyson ones shut down because they had COVID outbreaks, didn't impact our guys. In fact, it drove up the price of their products. So, it did cause construction delays like it did for a lot of folks on some of our development projects. And in the case of one of our hemp deals that was in New York, hit hardest. It caused a lot of revenue issues on that particular offering because, there's a lot of problems with that offering, namely the price of hemp fell right as we closed the deal. But there was also some revenue sales impacts. So, I'm a big risk mitigation guy. That dates back to my military time of I'm really into working with sponsors to identify what the risk in their offerings are. Because a lot of times I haven't thought about it very much. They've only thought about the good things about like, hey, this is how I'm going to make all this money. Cool. What's going to go wrong? And that's what I want to know about. So we're getting much better at as we do more of these offerings at helping the sponsor dig through their risk and mitigate it. And, things like power outages, the indoor farm guy might not be worried about the hailstorm, but he's definitely worried about losing power. So, does he have backup power generators? Does he have a swamp cooler for the summer in case his HVAC system goes out for 24, 48 hours? Dehumidifiers, all those sorts of things are things that you worry about on indoor ag that you don't worry about necessarily. But on the other hand, you're not going to get, a drought is generally not going to be a problem for an indoor farm like it is a row crop farm in the Midwest.
Thank you.
Hey, Chris, I have a question. I don't see anybody else ready to ask questions. So if you have one, just let me know. We have a few more minutes here. And I don't even know how to ask this question, to be honest, but when we're investing in the deal, say the salmon farm, what are we investing in? Are we investing in the crop? Are we investing in the farm? Are we investing in the company? How do you exit from that? Like, I don't understand exactly what you're buying into and then what the exit would be.
Yeah, great question. So you're investing into our special purpose vehicle LLC, which is investing directly into the operating company. And this is on equity deals. That's a different deal. On debt, if you'll see, one of our cattle notes will be upcoming in soon, and that you're investing into the SPV, the LLC, which is loaning company to the producer or loaning money to the producer collateralized by cattle. So it's kind of like and we've done equity into cattle too, but it's always into the operating company. So you're investing in a company, in a business, an agribusiness. We've done some things with revenue sharing that I didn't like and we won't do again. We've done a convertible note for the more, ag tech sort of deals. We've done convertible notes where you're going to get worst case, you're going to get a interest payment, or we're going to take possession of a piece of land, like we did a greenhouse where we basically put the down payment for the greenhouse or for the land down. And then our investors, if we were to ever forfeit that, will own a piece of land up in New Hampshire. We've other sorts of convertible notes where we're taking, we're going to convert into equity and have an interest in that company, either at a subsequent funding event or when they hit certain valuations.
Okay. Yeah, Tom, go ahead.
Yeah, Chris, based on your answer to Jim's question on the equity investment, does that mean you're getting ordinary income when you get a K1? Is it showing up as operating income as opposed to rental real estate?
Yeah, so you're going to get, our K1s are going to have ordinary income or ordinary loss. And then at the end, if there is a gain from the disposition of the asset, then you might have long-term capital gains.
Okay, any other questions for Chris? Okay, I'll ask one more, Chris, then we'll let you go. I appreciate your time. Can you talk about the fees that are associated? And also, is this open to only accredited, or are non-accredited also able to invest?
Okay, so we're doing Reg D, primarily Reg D offerings B and C. So in those Reg Bs, we're able to bring in at least 35 sophisticated investors, non-accredited, that we have a relationship with. And generally that relationship is built by coming on the platform and doing some back and forth with us, but primarily accredited investors. About 60, we've got 7,000 registered users and about 60% of them are accredited. But we have, non-accredited people invest all the time. As far as the fees go, most of those fees are paid by the sponsor. So, to register and build out a profile and just dig around our deals, that's obviously free. If you invest, the only thing that's coming out of your, in the form of fees, is not really fees, is we're going to drop your IRR a little bit to cover our carried interest. So, we take kind of an asset management fee. So like we're doing a 14% cattle note, we're taking 1% of it. It's actually a 15% cattle note. That's what the loan is written for. And we're taking a percent of that. So that's kind of typically how we do debt. And then on the equity side, the sponsor covers all the raise costs and our fees out of the raise.
Okay, I guess I do have one last question. Sorry. A lot of people in our group invest in small groups, so they invest with an LLC. Are we able to invest in the name of an LLC?
Yep, when you set up a profile, you set up your basic name profile, and then you just create an entity. And you do an LLC, a trust, self-directed IRA, whatever. We've seen them all.
Okay, Chad, did you have another question?
No, I'm good.
Okay. Great. If there's no other questions, I can share your contact information with anybody who wants it. So please just let me know. And Chris, just so you know, we're going to shift now to our regular meeting. You're welcome to stay. At the end, we do networking, but I also assume you might have other things to do. So it's completely up to you. Either way is fine. We really appreciate you coming on. This was very interesting. Like I said, I have a very little bit in ag, but mostly because I don't know what I'm doing. So this will help me kind of get into it a little bit more, because it's definitely some exposure that I want in my investment portfolio. So thank you very much. We appreciate your time.
Yeah, I appreciate the opportunity. Good luck.
All right. Thanks.
Thanks, Chris.
Okay. So moving on, there was a couple other items that we wanted to do today. And I thought I saw Waleed here, but he may or may not be at work still. I don't see him. Waleed, oh yeah, are you able to talk, Waleed? Or are you still working? Okay, I'm going to take that as he is still working. He was going to talk about a sponsor, so if he has time, he will do that. So instead of doing that, we'll move to Sean, who I know there's been a lot of talk on the forums and a lot of talk because there's been a number of ATM investments that have come up and with different operators, and they're all pretty much the same. But Sean was volunteered or voluntold to talk about ATMs today. So Sean, I'll turn it over to you.
Definitely voluntold, as you usually run, how you run this. So yeah, as Jim said, ATMs came across, when was that, 2-3 weeks ago, and it ended up being the same deal from Prestige, but many of us got it from Hunter Thompson, then we got it from Jeremy Roll, and we also got it from Dave Zook. What was interesting about the timing, it was just coincidence in that the podcast that Jim did with Dave Zook came out right before this. And I can't remember if it was released then or Jim knew that I was taking a look at ATMs and wanting to get into ATMs in 2021. So allowed me to preview or listen to the podcast before it was released. And so I set up a investor call with Zook, and then literally 2 days later, this fund comes out from these 3 different places. This is my first go at an ATM fund. If you look at the results and the performance alone of Prestige, it's really impressive. And the returns are off the charts, right, at around 25%. And so then I sat back and said, okay, well, which one of these 3? It's the exact same deal. Why would I go with Hunter, or why would I go with Jeremy Roll, or why would I go with Dave Zook? And what led me to Dave is, one, there's several in our community that are already investing in the ATM funds with Dave. So there's a proven track record there. And if we stick around our tenet of know, like, and trust, that is certainly there. But what may be more important for me is the fact that Dave is supporting left field investors. And so it's important for me to reciprocate that and support the people that are supporting us. So that was the direction I went with Dave Zook. The only thing that I don't like about it, which I knew going in, eyes wide open, and which is very common for ATM funds. So for those of you that are not looking at ATM funds, or maybe, are not in ATM funds, but are thinking of ATM funds, is that you do not get paid until 3 or 4 months down the line. And so my funding happened the middle when was it? It was March 1st, March 3rd, somewhere in that time frame. And so I will not see my first distribution check until July. So it's 4 months down the road. So as we know, it's hard enough to write these big checks and send them away to somebody that you've only spoken to for 20 minutes, 40 minutes, or an hour. Not now all of a sudden they're your best friend, in hopes of getting some distribution. But now to wait 4 months, that part's a little unnerving. But again, I knew that that's what the case was, and that confidence is there because of all the people that are in our community that are already investing with Dave Zook. So I don't know, Jim, if that scratches the itch you were looking for, but that's about all I have on it.
No, I appreciate that. I think one of the interesting things to me is when the first 2 kind of tranches of ATMs I invested in, they didn't give a K1, they gave a bill of sale. I didn't know what to do with that, so I gave it to my accountant, and he figured it out, apparently. But it's just, it fully depreciates, which is good for your passive cash flow. The new deal that Zook is doing is you get a K1. So that, I don't know what the change is there, but K1 just feels more familiar to me. So I'm pleased with that. I know Jeremy Roll has, he's really involved in this. He was kind of involved in Zook's ATMs. And, Jeremy, as you found out in the last meeting, is very detail oriented. So he went deep into the contract and, made some changes that are favorable to investors. So, I think if you're interested in this, with Zook or Jeremy Roll, either one of those, you would be good to go. So that, Paul has a question. Excellent. Paul, go ahead.
Thanks, Jim. Either to you or Sean, I'm actually interested in ATMs as well, and just kind of started doing my research. And I understand, given that it's a 7-year horizon, how fast can technology change during that time frame? And I understand also that cash is being used on a volume measurement more so than it has been in the past, although the transaction volume is down, if I understand that correctly. I guess my biggest concern and what I'm trying to get a little bit more comfortable with is just cashless transactions. And, my credit card now has a chip on it where I can just wave it in front of, where they take that type of technology. You're seeing, Apple Pay and other types of those things pop up. And I guess I'm just worried about obsolescence more than anything. Was that something that you guys considered as you were looking at making an investment? And if not, why? And if so, how did you kind of get over that?
Yeah, I'll jump in, Jim, and you can certainly fill in any holes for Paul. Paul, I certainly thought of it. I didn't really consider it from a major concern standpoint, because in my conversation with Zook, as well as either on the podcast or just in the materials that I got from him, they address all those issues. And where most of these ATMs are going are in spots where I don't want to say that a debit card or a credit card isn't going to be used, but certainly cash is still the predominant form of method of transaction. And I think, with a 7-year horizon, while in some cases that sounds like a long time, I think in other cases 7 years is going to go by very quickly, and so it's going to be hard for cash to be non-existent or minimized or marginalized in that 7 years. So I have, in 7 years time frame when this sunsets, maybe I'll feel differently about ATMs, but I think from now until that 7-year time frame, I think we're in a good spot with the investment, just because of where these ATMs are going and their proven track record and performance with them.
Yeah. The only thing I would add to that is that it's 7 years, right? But you're paid back in 4. And the return in year 1 with the depreciation is close to 40%. So by year 4, you're pretty much going to break even. And obviously that's not what you want. You want to do better than break even. But I think that kind of helps me on the risk on the other side. And, I can't remember the last time I used cash except to give to my kid to go buy ice cream or something. But that's not the way the rest of a lot of people operate. There's still a whole lot of people that operate with cash only. And if you look 4 or 7 years ago, we would have said the same thing. Cash is going out, right? But they have had more and more success with this since then. So I'm pretty confident that because it's such a short time frame, and I really just want to get the 4 years. I mean, I want the 7, but the 4, I'm pretty confident that 4 years from now it's not going to be that different. So that's kind of how I justify it.
Yeah, and I would say since funding this, which again was literally just 14 to 16 days ago, I've paid attention at different places where I've been and where these ATMs, like what the Prestige Fund will own, have been. And literally this weekend, for those of you in Columbus, I was down at St. Charles and had to run to get some coffee at the Turkey Hill. And there were no less than 8 people in line to use the ATM outside the Turkey Hill. And I thought, this is insane. And those are the types of places where these ATMs are going to be, in the convenience stores. I don't want to call them pop-up ATMs, but they're those kinds of places, as opposed to a bank ATM where somebody has to go to a branch to get it. It's going to be in those convenience stores where somebody's like, you know what, I need some cash real quick, and they're going to access it that way.
Yeah, that's good perspective. I appreciate both your opinions. The other question I have, and I'm sure this is in the PPM that I have not read yet, but the 104,000, how many ATMs does that buy? Obviously you're investing in a fund that's diversified, but what does an ATM actually cost?
I think that in the one that I did most recently, I think I got 3 ATMs for $52,000.
Okay.
And you get the serial number of your actual ATMs, but you get the results of everybody's ATMs.
Yeah.
So Wally, did you have a question?
No, I was just going to add to a little bit of perspective about the ATM deal. So I did invest in the one that was with through Jeremy Roll. And the reason I did that is because the contract is a little bit different. If you look at it between the different sponsors, or the people who are kind of feeding into this deal or gathering investors for the group, they actually had a separate contract added on to after the fact. So when you go to actually invest, there's an extra document that's included in there, and it's about how the deal exits if you can't like access it, how much money you would get back, and all this other stuff. But Jeremy Roll is very thorough in terms of what the agreement looks like. So I ended up going that route just for that reason. And then I had a lawyer buddy of mine just kind of peek over it and kind of go through it. And he said it was fine if I felt that the investment was good. And then just to add, as far as like ATMs go, I feel a little bit more comfortable with it because my dad sort of worked in ATMs where he actually bought his own ATMs and then would put them in little shops and would make money off of it that way. Turns out you make a lot more money if you're actually, I don't recommend this for people, but if you're picking up the cash from the bank and manually depositing it into the ATM, you get a bigger cut of the transaction, of each transaction. And these things turn out quite a bit of money each time. And what's interesting is that the little shops, like, you know, the little grocery stores or the little sandwich shops or whatever, those are the ones that actually produce a decent amount of transactions per month. And then where you park these things, when they talk about, like, you'll listen to Dave Zuck, and that they really target the markets where these are used as a primary banking system. And I've seen that firsthand because of the area that I grew up in New York. That's all you saw. And I mean, that's literally, I mean, some of these ATMs will churn out like 5,000 to 10,000 transactions a month. And it turns out if you actually want to buy your own ATM, it's about $3,000 to $5,000, the cheapo kind. If you want to get the real fancy ones, those can go upwards of like 15 to 20,000 a pop. But if you look at the actual transaction volume, and I actually had my dad, I was like, hey, can you send me your transaction volumes for all these areas? And it's true, it's sort of the lower income areas had higher transaction volumes. And these things turned out quite a bit. So that's just my personal take and why I ended up going with that fund, because I sort of at least felt more comfortable conceptually and having sort of seen it, touched it, felt it type of thing. So anyway, just a little different perspective.
Hey, Wally. They talk about, I invested in the Buck Joffrey's fund back in December, which is also through Dave Zook's group, but they talk about the life cycle of an ATM. You know, since you have sort of secondhand experience with it with your dad, is it about 7 years or a little longer or shorter?
Yeah, it depends on the type of machine you get. So if you get a higher quality machine, those can go for about 7 years. Most people don't rely on them more than 7 years. So it's not uncommon. Like the ones that my dad has are the cheapo kind, like $3,000 ones to $5,000 ones. But those will give them about 5 years. And each of the contracts, they contract out for 5 to 10 years. So typically the contracts that you establish with the location is longer than the actual lifetime of the ATM, because you're trying to draw it out as long as you possibly can. And you're trying to have that machine die out before the contract does. Anyway, that's how my dad ran it and how other people ran it. But it's interesting, once you hit a certain volume of ATMs, you can then become the, I forget what the term is, but basically the processor. So you can also then hold a processor, like, I guess, status, where you can, once you have, I think, like 30,000 or 50,000 ATMs under management, then you can actually become a processor, and then you can then recapture the cost that the processor takes, because you get a cut, the bank gets a cut, the processor gets a cut, and on and on and on it goes. And also the location, typically you give them like a concession, you give them some money for each of the transactions, and they make cash off of that as well. So by splitting it many ways, if you can take over the processor, then you then really kind of skyrocket as far as how much per transaction you can get. And it's like, you're talking like 30 cents to 60 cents extra, but that, you know, when you're talking about 30 to 50,000 machines, that adds up. So.
Anything else on ATMs? All right, we're gonna close up and we're gonna do networking next. And so, Waleed, we were gonna have you talk about a sponsor, but we'll do that next time if you don't mind. I'd like to keep the content part of this to an hour as best as we can. So if you are not interested in the networking, go ahead and drop out now, please. And then I will see you next month when we have Brian Burke is our guest. And I believe it's It's the 4th Monday in April. So whatever that is, I don't remember the date. So if you're not going to network, I'll give you a minute or two to drop out, and then I will readjust the rooms so that we have kind of a equal footing there.